All verified Bitcoin transactions are stored via blockchain, a type of database which stores data electronically. The primary difference is that databases use tables to structure their data, while blockchains store data in blocks. When a block is filled, it's added, time-stamped and chained to the previous one. This creates a record with readily accessible data and an immutable timeline. Like databases, blockchains require multiple computers to manage and store data. However, databases use servers, which tend to be owned by a specific person or entity, whereas blockchains store data on multiple computers owned by numerous people or entities. Bitcoin's network includes thousands of computers called nodes, all working together to verify transactions, fill blocks, and keep the system functioning. In Bitcoin's early days, miners worked quickly to validate transactions. As the digital currency has exploded in popularity, transactions have become more numerous and complicated. The Bitcoin transaction fee was initiated to speed Bitcoin transaction validation. Fees are tied to the size of the transaction and input age. In other words, a transaction that comprises more bytes that take up more block data will have higher transaction fees. Additional fees can speed the transaction through the system, essentially placing it in a priority queue. In other words, you can pay more to have transactions validated faster. Collected fees go to the miners, who validate and record the Bitcoin transactions and help keep the system fluid and functional. Conceptually, Bitcoin transaction fees represent the speed with which a user wants their transaction validated on the blockchain. Although the decentralized nature of Bitcoin makes it easy for anyone to participate as a miner, which means verifying and recording transactions to form a block and are joined by a chain. However, the process of mining Bitcoin is both complex and expensive. Mining rigs are expensive and oftentimes consume massive amounts of electricity, while the block subsidy and transaction fees help offset these costs and incentivize miners whenever a new block has been validated. Miners are granted transaction fees and block subsidies as a block reward whenever they successfully added a block to the blockchain. The block subsidy is fixed with each Bitcoin mining and was reduced by half, called Bitcoin halving, which will happen every 4 years or every 210,000 blocks. Looking back at 2009, a mined Bitcoin would earn you 50 Bitcoin, but as the years passes by, the rewards were halved, and the latest halving in 2020 set the rewards at 6.25 Bitcoin. The last point is under the user's control. If you need your Bitcoin transaction to be processed urgently, you can opt to pay a higher fee to prioritize it. If your transaction is less urgent, you can opt for a lower fee. The mempool can be thought of as a queue. When you initiate a transaction, it goes to the mempool. Transactions which are waiting remain in the mempool until a miner confirms and adds them to the block. When the mempool fills, miners choose Bitcoin transactions with higher fees first. This system can keep transactions moving more smoothly, but it can also lead to a kind of bidding war. Many people using cryptocurrencies are willing to pay a premium to ensure their transactions are completed first. However, this tactic can backfire, especially during periods of heavy use. Some users end up overpaying fees, which forces other miners to also increase their fees. Transaction fees are a necessary cost of performing financial transactions in the 21st century, and cryptocurrency transactions are no exception. Both Bitcoin and Ethereum link the cost of the transaction with its size, and users can pay more to speed the process. The average Bitcoin transaction fee fluctuates from day to day, depending on the amount of traffic and other factors. On the Bitcoin network, about 200,000 to 300,000 transactions are completed daily. Ethereum, on the other hand, completes over 1 million transactions each day. Completing your transactions on a day when traffic is light can lower your transaction rate, without forcing you to compromise on verification speed. Hefty Bitcoin transaction fees are attractive to miners, but might not be as popular with users. The fee structure can be such that some users are paying the equivalent of their transaction amount in fees, particularly when it comes to smaller transactions. Transaction fees aren't the only issue dogging Bitcoin. Scalability is also proving to be something of an Achilles heel. The Bitcoin protocol clearly defines the block size and generation, which restricts Bitcoin to about 7 transactions per second. To change the Bitcoin protocol, its users must all agree on and choose a specific software. Lightning Network offers an alternative that's designed as a Layer 2 payment protocol, which means it's layered on top of the blockchain. With Lightning Network, you can complete numerous transactions before closing the payment channel and settling the final transaction with the blockchain. The Lightning Network is an off-chain solution that sits on top of a blockchain not exclusively on Bitcoin's network, primarily helps to process blockchain payments quickly and securely without potentially lengthy block confirmation times. It even allows users to complete cross-chain atomic swaps instantly without relying on third parties. One of the key highlights of the Lightning Network includes its ability to allow for small payments, even less than a Satoshi. The process is more private, allowing for multiple individual transactions to occur without being broadcast via the blockchain. As its name suggests, the Lightning Network is fast too. For those in search of privacy, speed and affordability, Lightning Network offers an excellent alternative. Much as a traffic jam causes congestion, a greater number of transactions waiting on a network results in slower movement and higher fees. Ergo, fees tend to increase during times of peak use. If your Bitcoin transaction isn't urgent, you can camp out and wait for an opening, much as you might choose to leave a little later in the day to avoid rush hour traffic. The blockchain tends to have predictable peaks and valleys, due to businesses completing larger transactions. Waiting until the weekend to complete yours could mean less traffic, faster clearing transactions and smaller fees. That's one of the advantages of markets that never close. While custom fees are possible, still, miners prioritize and process transactions based on several factors, including the size of the fee. Your larger transactions might take a little longer to complete, but they will be added to the blockchain, usually when the traffic slows.
If you found this article useful, please consider subscribing to our YouTube channel. You can also visit our website, where you find great educational contents about cryptocurrency. As a member of our Cryptocurrency Academy, you'll have access to exclusive resources and tools to help you stay informed and make better trading decisions. Additionally, discover and join our Discord. Our Discord server will provide a supportive network of like-minded individuals who can provide guidance, advice, and encouragement.